So have you ever thought about reducing your taxes, particularly in retirement? So again, reducing your taxes in retirement, how beneficial could that be to you? There are strategies that anyone can implement. They just need to know how to do it. Give me a few minutes. We'll go over it right now. So you're making this transition into retirement, or you're currently retired, and you're asking yourself, why am I paying so much in taxes? I talk to people week after week around the country that are in a situation where they're paying more in taxes in retirement than they thought they would pay. But a lot of times they have more income in retirement than they thought they were going to have. And that's the reason that they're paying more in taxes. And this it has kind of a trickle down effect. When you're making too much in retirement, which is, how do you make too much in retirement? There's different ways to look at that, which we'll cover. Great to make money, not great to pay taxes on all of that money that you're making. But the trickle-down effect, it starts to affect things. If you're over 65 and you're on Medicare, then your Medicare Part B, you're paying more for the Medicare Part B insurance than other people are if your income is above a certain level, and it just keeps going up. What if you're under 65 and your income is too high and now you're trying to get health insurance? Well, then you're going onto the marketplace and you're paying more for that insurance than other people are paying that have higher incomes. So strategies that reduce income, again, you still have to cover your expenses, but if you can reduce income, and then also by reducing income, reduce the taxes that you're paying on that income, it's going to be important moving forward. So let's go through just a couple of things that people are looking at on a fairly regular basis. And one of the sales pitches that I've seen time and time again that just makes me want to just light my hair on fire, it's absolutely hated, is companies using annuities to reduce taxes. The problem with that is to call that a reduction in taxes is a little bit misleading. It's a deferral of taxes, not a reduction in taxes. So if you put money into an annuity account and it's allowed to grow inside of that annuity, and you're not having to pay taxes on the gains that you had in a particular year because you didn't take a distribution, it doesn't mean you don't have to pay the taxes, or it doesn't mean that your beneficiaries don't eventually have to pay the taxes. It just means that you're deferring those taxes. And by the way, when they pay them, they're going to be pay those taxes. The taxes are going to be as ordinary income. So be careful, don't fall into that trap. But if we go through strategies to make this work, one of the most obvious ones that I know a lot of people have heard about is a Roth IRA. Right, or a Roth 401k. So the idea of a Roth is you pay taxes on the money before it goes in, and then the gains or income later when you take it is going to be tax-free. So one of the best strategies for reducing future taxes is to have those retirement assets in Roth. But the barrier to entry, if you want to call it that, or the issue to getting into the Roth is paying taxes ahead of time. So then you start taking a look at your 401k account. You start taking a look at your IRA accounts. You start looking at 403b maybe, whatever your retirement account is at work. And you say, all right, well, I really wish this was a Roth, because if it was a Roth, I wouldn't have to pay taxes on it in the future. I wouldn't pay taxes on gains. I wouldn't even have to take a required minimum distribution on the account if it was a Roth. But the conversion from your retirement account to a Roth account is a taxable event. So finding a way, number one, to convert assets from traditional IRA or 401k or what have you, non-Roth assets, over to Roth accounts can be very, very beneficial in reducing or eliminating taxes on that portion of your money, but you need a strategy to do it. It's not as simple as, well, I've got $500,000 in my 401k. I think I'll just convert all of that to Roth. Well, if you were to do that, then you just had an additional $500,000 of income taxable in that year, and you probably push yourself up into a higher tax bracket. So there is a methodology to that conversion, and it can be done pretty easily as long as you can find somebody to help you do those calculations and find out, all right, how much should I convert on an annual basis? How much is it going to cost me in taxes? And let's just have a plan. So that would be one way to go about doing it. Another way to look at reducing taxes or even eliminating taxes in retirement would be to look at tax-free investments. Now, tax-free investments, things like municipal bonds, are beneficial, but they're not going to be beneficial inside of a retirement account. So if you start adding tax-free investments inside of an IRA account, all you're doing is getting a lower rate of return on something that's going to be taxable anyway, because there's no way to get the money out of your IRA without paying tax. So that would be an investment option that you would potentially want to look at in order to benefit, but would have to be on things like individual accounts or joint accounts or trust accounts. So it's very specific. You could benefit from that, and the right investment advisor could help you there. Another thing to look at is just pay attention to the amount of taxes that you're paying, particularly when it comes to, again, trust accounts, individual accounts, joint accounts. Those accounts are taxed based on how long you've held the underlying investment. And so it's considered what's called a capital gains tax, or something called a short-term capital gains tax. And then there's a long-term capital gains tax. And I know it gets a little bit confusing, but essentially short-term capital gains, that would be any investment that you've held for less than a year. So you bought it and you sold it. So this could apply to stocks or anything in the market, even apply to bonds. It could apply to real estate. It applies to a lot of things. If you bought something, for example, I paid $100,000 for it, and 6 months later or 10 months later, it's worth $150,000. If you sell it in that moment, it's a short-term capital gain, and short-term capital gains are taxed as ordinary income. In other words, the maximum tax rate. So be cognizant or aware of that 365 days, because if you waited over 365 days, so say 366 days, now it's a long-term capital gain. And depending on how much it is, there are levels, but for most people, that's going to be at 15%. So would you rather pay 15% in tax on an investment, or would you rather pay ordinary income taxes, which could be over 20% or over 30%? So there are ways to help yourself, whether you're in retirement, whether you're considering retirement, whether retirement is 20, 30 years down the road. Just be aware of the options that are available and how to take advantage of them, and make sure you're not paying more tax than you have to. It's okay to pay tax. If you're paying tax, chances are you had a gain, and that's a good thing. But don't pay more than your fair share when it comes to taxes. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.